Now we'll go into the second portion of this presentation. This is critical to understand how we can do everything that we indicated in that first presentation. We'll go through some of the legal background, the Supreme Court, even our Constitution backs our trust. So we'll go into all of that. So this presentation, we're going to cover the following topics. We're going to cover contract law. We're going to cover sales and transfer of assets in and out of the trust. We're going to cover demand notes as a key feature with our trust. Works very well with all of our clients. Seizure of assets is a key thing. We wonder, well, can anything be taken away from us? We'll go into extraordinary dividends and why that is authorized with our trust and how that works. We're even going to cover annuities, and we'll go into insurance policies near the end of this presentation. It's a powerful side of how this trust works. You'll see some things with this insurance business that really can grow wealth. We're going to cover it, and the insurance part of this covers as IRS provides a way for us to do this and keep it all tax-free at the same time. Let's go through contract law first. So our trust now is defined by Black's Law Dictionary as the right of property, real and personal, held by one party for the benefit of another. The trustees hold the legal and equitable title to the property for the benefit of a beneficiary. It's a basic principle of how the trust works. Although the trustee holds the property title, they do not own the property. Kind of key with this trust compared to all of your grantor type trusts where the property is still owned and managed and held by the trustee and the beneficiaries. In our trust, it is not. The trustee is just a fiduciary of the trust. So the trustees are designated the management authority for the Spendthrift Trust organization. As we showed in the other slide, you see a settlor creates a trust, hands it off to a trustee who creates beneficiaries, and the trust holds the assets and the trustee manages those assets. So a Spendthrift Trust organization is created and given life through a contract, a unique fixture with our trust. It's not just a written document, it's in fact a contract and based on contract law. It's a contract in the form of a manifestation of intention in the terms and conditions of the Spendthrift Trust organization. And this is just the trust document itself, the instrument. Contract in the form of a Spendthrift Trust does not owe its existence of any act of the legislature. We say we're not subject to legislative rules and regulations, and there's a mechanism for why this is so. The authority of this creation is in the common law right of the parties to enter into a contract. In American law, the government cannot impose a tax upon a right to contract. The right to contract is guaranteed under the Constitution. You see that in the U.S. Constitution under Article 1, Section 10, Clause 1. Which basically says no state shall impose any law impairing the obligation of contracts. Because a Spendthrift Trust is not a creature of the legislature, it is not subject to the myriad of strangling legislative controls, rules, and regulations that are applicable to all corporations and other legislative entities. This is a unique feature with our trust and gives the trust very powerful tool. Although we're not subject to the legislative rules and regulations, we still want to be prudent with, say, the environment and do things that are not in violation of a lot of the rules and regulations, but we're not actually subject, and the Constitution gives us that authority that we're not fully subject to those rules and regulations. The Supreme Court in Elliott versus Freeman ruled that a Spendthrift Trust organization is not subject to legislative control. So people say, well, what do you base that on? Why can you say you're not subject to legislative control? Well, our Supreme Court right there has ruled that it is not subject to legislative controls. And guess what? The Internal Revenue Service is a legislative body. The Supreme Court holds that the trust relationship comes under the realm of equity based on common law and is not subject to legislative restrictions as corporations and other organizations created by that legislative authority. You know, when you get a form of corporation, what do? You have to go to your state government and you actually file for incorporating your corporations or forming. Then you get Internal Revenue Service involved to get your EIN numbers. We still get EIN numbers, but we're not subject to all those rules and regulations. Let's talk a little bit about sales and transfers of assets and demand notes. A contract between an individual entity and a spendthrift trust is an agreement creating obligations enforceable by law. The basic elements of this contract are mutual assent, consideration, capacity, and legality. Contracts for sale, obligations, promissory notes. Any of those type things are legally binding obligations. It's bound by contract law. So those things are binding. Such values of such transactions with a trust is generally determined by market value analysis. That is, what a willing buyer will pay for and what a willing seller will sell for. So we're not subject to some of the things that we got to do when we sell property. The Internal Revenue Service requires a lot of these time restraints, and then you've got to get certain appraisals and go through a whole bunch of jump through a whole bunch of hoops and everything else and do a bunch of things to be able to sell your property. Our asset values are based on what a market value, what a buyer will pay, and what a buyer will buy for and what a seller will sell for. Sales of assets held in a spendthrift trust are not subject to seasoning. That's kind of critical too with our trust. A lot of times we consider that IRS so much time has to go by before you can actually sell a property with going through all the rules and regulations, but with our trust we're not subject to seasoning. What's that mean? We could actually purchase a property 1 minute and theoretically we could turn around and sell it the very next minute if you could do all the paperwork that fast to get the sale accomplished, but theoretically you're not restricted to the time that you have to hold an asset before you can sell that particular asset within our trust. We also create demand notes within our trust. And what's that mean? A demand note is a legal form of a promissory note without an amortization of required payments and interest on a set schedule. So a demand note is just that. It's based on when the holder of the note demands payment on the note. As assets are transferred or sold to the trust, the basis in that asset is added to the demand note of the person transferring or selling the asset to the trust. This demand note is not subject to seizures or claims by any court or jurisdiction. The demand notes also, with the way our demand notes are written, they're not subject to inheritance or anything like that. We want the trustee to honor the demand note, so when the deceased owner of the demand note passes, the trustees in most cases, again mostly because of accounting principles, they're going to assign that demand note to the heirs based on the wishes of the original holder of that demand note, and usually that's based on how they spelled out those requirements within their will. You can't will the demand note, you can't put it in there, it's not subject to any demands by any of the heirs. It's all at the discretion of the trustee. What about seizure of trust assets? Fortunately, with our trust, that cannot happen. Property held by a properly constructed contract in the form of a spendthrift trust cannot be seized. Further, the trustees and beneficiaries are not liable for the debts of the trust organization. And this was determined in a Supreme Court case of Hussey versus Arnold. A trust organization is immune to tax liens, levies, and seizures, lawsuits, divorce claims, bankruptcy, any of those type things. Our trusts are not subject to those actions. A spendthrift trust organization is not liable for the debts of the trustee or the beneficiaries. And in turn, the beneficiaries are not liable for any of the debts, let's say, of the trust too. So it works in both directions that way. Let's take a look at the Internal Revenue Code, but that's what we do follow. Remember those three things that the trust is based on. The third thing, the lower priority thing, was the IRS. We want to use the IRS code to our benefit, and we want to be able to defer taxes on that income, as we showed in the first series of slides. So we do that through the Internal Revenue Code in declaring that income, that passive income, as extraordinary dividends. How are we able to do that? Let's take a look at the Internal Revenue Code itself. Title 26, Subtitle A, Chapter 1, subchapter J, part 1, subpart A of 643. So we usually always just say IRC 643, Internal Revenue Code 643 to kind of abbreviate it. But sections of that Internal Revenue Code spell out, and that subsection 3 spells out that capital gains and losses or exchanges of capital assets shall be excluded from income to the extent that such gains are allocated to the corpus of the trust. That last part of that sentence is critical. They have to be allocated to the corpus of the trust. Our trust, being a discretionary trust, gives our trustee the capability of allocating those assets to the trust. So section 4 goes on even further to say that extraordinary dividends and taxable stock dividends shall be excluded. These items of gross income constituting extraordinary dividends or taxable stock dividends which the fiduciary acting in good faith does not pay or credit to any beneficiary by reason of his determination, again, a discretionary trust, that such dividends are allocated to the corpus under the terms of the governing instrument and applicable local law. So these parts of the Internal Revenue Code give us the tremendous power that we have to grow wealth within our trust by deferring that passive income and using it in the trust to grow additional wealth. The subpart 7 of the IRS Code also goes on again to state that items of gross income constituting extraordinary dividends or taxable stock dividends which the fiduciary acting in good faith determines to be allocable to the corpus under the terms of the governing instrument applicable to local law shall not be considered income. So we get asked the question all the time, how can we not pay taxes on that income? The Internal Revenue Code right here spells out in very, very clear language that if we do it correctly, the trustee can allocate those passive income to the corpus of the trust and determine at their discretion that it's extraordinary dividends. We go a little step further to make all that locked in concrete. We actually issue a extraordinary dividend statement at the end of each year, which declares, since the IRS Code says the trustee has to declare it, I actually produce a statement for each trustee that declares that extraordinary dividends then as such and declares it and moves it to the corpus of the trust each year. They provide it to them, they sign it, keep it with their trust, so it can be shown that they did in fact declare that income as extraordinary dividends. What about tax avoidance, tax evasion? The okay word there is avoidance. The bad word there is evasion. Evasion will put you in jail. So we have to be careful of the last part of that. We can go with the tax avoidance. We can do that. That's completely legal. But the tax evasion is a serious problem. We have to avoid that at all costs. In Weeks versus Sibley, Edwards versus the IRS Commissioner themselves, and Phillips versus Blankard, we find that the courts ruled that a spendthrift trust organization is not, keyword, is not illegal, even if formed only for the sole purpose of reducing or deferring taxes. So if your only wish is to defer your taxes on all your passive income, it is not an illegal act to do so, even under this particular Supreme Court ruling holds that up, and it is not an illegal action. Edison California Stores versus McColgan kind of states the same thing. The person may adopt any lawful means for the lessening of the burden of paying income tax. You say, oh, the IRS won't like that, but look at the next slide. The Department of the Treasury, the IRS handbook that they give out to all their agents, their special agent book number 412 on tax avoidance specifically states that avoidance of taxes is not a criminal offense. That's written right out in the Internal Revenue Service handbook to their agents. Avoidance of taxes is not a criminal offense. So that goes to that Supreme Court ruling that any legal means taken, we can reduce or defer those taxes. Any attempt to reduce, avoid, minimize, or alleviate taxes by legitimate means is permissible. and authorized by the Internal Revenue Service. They want you to reduce your taxes if it's legal and possible to do so. We can't do evasion, but we can do avoidance. Pursuant to Narragansett and Buchanan, it is not an evasion of legal responsibility to take whatever advantage may accrue from the choice of any particular form of organization permitted by law. And our trust is an organization permitted by law. Let's take a look. Our last part of our presentation here goes into annuities and insurance policies. The main part of this we'll go into will be the insurance policies. But let's take a look first at what with non-qualified annuities. The IRS has a good code section, Section 72U, which addresses with annuities that the tax, the distribution of those annuities, the tax-free portion of those annuities, maintains its tax-free status even when held by our trusts. The Spendthrift Trust. This income is treated as extraordinary dividends. Under IRC 643, we declare it extraordinary dividends, we move it to the corpus of the trust, and no current taxes are paid. So, again, that goes into, this slide shows that subsection 7, which shows that income shall not be considered income if it's declared by the trustee as extraordinary dividends. One of the powerful vehicles within our trust is insurance policies. We're going to take a look at this as an instrument for building wealth within a trust. One of the things we want to do with our Spendthrift Trust is eventually build wealth. That's the whole idea of this trust, not only protecting your assets, but you want to build wealth. And an insurance policy, we're going to see, will have a tremendous vehicle for doing that. The trustee of a Spendthrift Trust may purchase and hold insurance policies on the trustee or on the beneficiaries even, any type of policy. We're going to mainly talk about life insurance policies at this particular time. The death proceeds of such policies that are tax exempt when passing to the trustee or the beneficiary of an IWS banking policy to whom the holder is written, holder of that holds that tax exempt status when it's distributed to that person named in the policy. And the Internal Revenue Service gives us the authority to do that through IRC Code 7702. That even holds with our trust. So we're able to pass that income from the policy, or the death proceeds on that policy will pass to the trust tax-free, and we then in turn, through the use of our demand notes, the proceeds pass to the trust. We also at the same time then increase the demand note by that same tax-free amount, which gives that tax-free amount available through the demand note access to the beneficiaries or the people that would have normally been the heirs to that person that passed away. If it's a trustee, we always use an example of the trustee passing, but we could have a note for a beneficiary and do the same thing through their heirs also. Also, the benefits of the policy may be distributed to the heirs of that holder on the death of that person. Payments on the demand note, being after-tax dollars when conveyed to the heirs, also pass through tax-free. So we find that tax-free proceeds then from that death benefit then, having been added to the demand note, is now accessible to the heirs through as tax-free draws against that demand note. So let's take a look at an example here. Let's take a look at the trust purchases a $10 million IWS banking policy on the trustee. Let's say it's on the trustee instead of a beneficiary. We'll use the trustee. We always pick on trustees in our slides here, but we'll do that. So we got $1 million. The trustee puts $1 million into the trust. The trust now has $1 million in its bank account. It uses that money to purchase that IWS banking policy itself. So it purchases, let's say, a $10 million policy on that with that $1 million premium payment. The IWS banking policy, specially engineered whole life policy, let's say it's paying around 7%, give or take, more or less, depending on the policy and how it can be structured. It can pay more in some cases, but that's a tremendous return when you figure our prime rate now is about 1% or less in some cases. So it's a terrific vehicle to grow wealth through the policy. The trust borrows the let's say it was a 7% return on that policy. It said it's got $1 million in cash value right from the beginning. It could draw $70,000 of that cash value off of that IWS banking policy immediately almost, and to use that to purchase either more policies or to purchase other investments for the trust. And again, our whole objective here is to grow wealth within the trust. And the IWS group has a very excellent way of doing just that through these banking policies. They have an amazing way of you growing wealth through that. Rockefeller spelled out how to do it, and they're applying that in real life today. The trustee carries a note payable on the loan. The trust carries a note payable on that loan. And then the $70,000 goes into the trust bank account. It borrowed the $70,000. Now that money goes into the bank account. It could, in fact, then, since the trustee also has $1 million on his demand note, that loan, that $70,000, the trustee could draw that amount out tax-free from the demand note. So in essence, the loan on the insurance policy then could be drawn out by the trustee to pay for things the trustee wants to do that particular year, maintaining its tax-free status the whole time. Or the trustee could decide to leave that $70,000 this particular year into the trust to either buy other policies, to grow more wealth, or to purchase other assets, real estate properties, or things like that to grow wealth within the trust. Beautiful, beautiful vehicle for the trust to use. Let's say, unfortunately, now that the trust dies and the successor trustee steps in. So what happens now? Now the trust receives the insurance proceeds. That's the way it's set up to do, right? So now the first thing the trust has got to do, though, it's got to pay off the note, that payable that was built every time it took out those payments against the note. It's got to pay that off, and then the rest of the proceeds then are in the bank account of the trust. So from an accounting standpoint, we have to have a way now to balance the books. So that same amount of money gets added to the demand note of the original insured on the policy, which in turn then gives the heirs access to that money 100% tax-free. So that's a beautiful way of how we're still able to maintain that tax-free status even with our trust, to take the proceeds of that policy, pass it through to the heirs if they want to take the money out, or maybe they want to leave it in the trust and grow more wealth. Hopefully we'd educate those heirs to leave that money in the trust and continue to grow the family wealth within the trust. But here's a big thing with this particular setup: by the trust owning the policy, being the beneficiary in the policy, the policy itself stays out of the insured's estate. Right now, the inheritance tax exemption level is at $11,100,000 right now. A little bit over that actually right now. They increase that each year with the rate of inflation. But right now, a little over $11 million is exempt. But we used to see back in 1986, when the Democrats owned all three branches of the government, the rate was $600,000. So you could find a $10 million policy, 55% of that proceeds being included in your estate, and losing that 55% of that tax-free supposedly income would be going back to Uncle Sam in death taxes. But with our trust, we get to keep all of it tax-free. We'll go back as a little bit of a review now on the beginning of our other presentation that we gave first, and the setup of the trust. How our trust is structured is a settlor creates a trust and then turns it over to a compliance overseer, or the guardian overseer of the trust itself. Then the settlor steps out of the way and is no longer associated with the trust. The guardian now assigns a trustee and successor trustees, and then the trustee assigns a beneficiary. The trust then operates for the benefit of the beneficiary. Remember again, one of the powerful examples we gave in the first part of the presentation with the tax advantage of the trust. We had the trust had income of roughly $196,000 and expenses of around $43,000, leaving trust income of about $153,000. If you didn't have a trust and that was all your personal income, you'd pay about $20,000 of that in taxes. But with the trust, you pay no tax on that, and the entire $153,500 would remain in the trust as extraordinary dividends to continue to grow wealth within the trust. A very, very powerful vehicle. Some of the benefit items here, you see all the listing here. All those things are 100% deductible as trust expenses, whereas on your personal tax return, 99% of those items cannot be deducted on your personal tax return.